hope you're not fed up of hearing about this, but inflation is again going to be the hot topic of the week ahead. And before we go into the details, here's a reminder of why inflation is so important from an investment perspective. Inflation has been dormant for almost 40 years, ever since the Paul Volcker-led Federal Reserve and successive chancellors of the Exchequer under the Conservative Prime Minister Margaret Thatcher crushed it in the early 1980s. Here we go. So if inflation goes up, so, in theory, should interest rates and bond yields. That means bond prices go down. It also means the yields on cash and bonds may look more attractive relative to the yield available on shares and could even potentially be bad news for stock markets. If inflation goes up, history suggests investors will look to real assets, like commodities, or those that own them, like mining and oil stocks, or property in firms whose revenues are potentially index-linked, like commercial property landlords or maybe even utilities. Investors might be less keen to own paper assets. And if inflation goes up and stays up, well, potentially everything that's worked from an investment perspective for the last 40 years, bonds, secular growth stocks and paper assets may stop working, or certainly stop working as well. And what's been out of favour for 40 years, real assets, value, cyclical stocks and even gold, well, they could in theory come back to their own. Now, we have to acknowledge that the past offers no guarantees for the future, and that's even if that's all we've got to go on. But this debate has huge implications not just for the value of your money, as its purchasing power will go down as fast as inflation remains above interest rates, but also your investment portfolios too. Just check out this chart. It shows the value of the Bloomberg Commodities Index relative to the FTSE All-World Equity Benchmark. If the line goes up, real assets are outperforming paper ones. If the line goes down, stocks are beating commodities. This is why some strategists are asking the question as to whether a rise in inflation could represent a generational tipping point in how investment portfolios perform. Anyway, the US Federal Reserve and the Bank of England both continue to describe the current spike in inflation as transitory, in the view it's caused by pent-up demand as lockdowns ease and supply chain dislocation is caused, and both factors they view as temporary. But central banks in Brazil, Mexico or Russia are already raising rates and citing inflation as the reason why. They think it might not be temporary. Officials from the Fed and Bank of England have already begun to refine their position anyway, saying that inflation could run a little higher for a little longer than they initially expected, but neither showing any indication of either rushing to raise interest rates or throttle back on quantitative easing. Whatever, the latest batch of inflation figures will be the next test of central bank policy. On Tuesday the 13th of July, we get the US numbers, and last time around consumer price inflation was 5%. And on Wednesday the 14th of July, we get the UK numbers. Last time around, prices as benchmarked by the CPI rose 2.1%, the first time the figure would come in above the Bank of England's 2% target since November 2018. On the corporate front, trading statements, mainly first-half sales figures, will dominate proceedings as we get ready for the first-half reporting season, which kicks off later this month. Names which may be worthy of further attention include the following, although please do note that these dates could still be subject to change. Babcock and Dechra Pharmaceuticals on Monday the 12th of July, Kier on the 13th, Dunelm, Tullow Oil and Barrett on the 14th, JustEatTakeaway.com, Experian and Asos on the 15th, and Rio Tinto, Burberry and Frasers round off the week on Friday the 16th of July. But for all of those names, the company which could just cause the biggest fuss in the week ahead is the recruitment specialist Hays. The FTSE 250 firm is due to release a fourth quarter trading statement on Thursday the 15th of July. Fellow recruiters and FTSE 250 members Robert Walters and Page Group have already provided some insight of their own with their second quarter updates on the 7th of July. Page reported 94% growth in gross profits and, perhaps more insightfully, a 2% increase against Q2 2019. The company also upgraded its profit forecast for the year by 25 to 30%. Robert Walters reported its first year-on-year increase in fees since Q3 2019 and also raised its profit expectations for 2021. Shareholders might find the recruiters' commentaries insightful, and not just because of what the firms have to say about their own fortunes, but because of what they have to say about the wider economy. A strong economy should be good for jobs and good for recruiters, although the opposite also applies. This all sets the stage for Hays. Its third quarter fee income still dropped 10% year on year on a like-for-like basis, although that nevertheless was an improvement in momentum. Germany was the highlight with a drop of just 5%, while the UK and Ireland section was the laggard, down 14% like-for-like. In terms of profits, Hayes guided to operating profit of at least £85 million at the third quarter stage for the whole year, as boss Alistair Cox flagged improved business momentum and also good cost control. Shareholders will be looking for signs of whether that guidance holds or is now too conservative, or, in the worst case, too bullish. I hope that you and your families are on good health and good spirits. Thank you for listening, and I look forward to talking to you all again next week.